Hi everyone, and welcome again to Nettle, the go-to place to learn about business, finance, economics, and much more. Please don't forget to subscribe to our channel and click that bell notification button below so that you never miss fresh videos and tutorials you might be interested in. Many thanks to our current Patreon supporters and YouTube members for making this video possible, and would also greatly appreciate if you consider supporting us as well. So please click the link in the description and click the join button below for more details. My name is Sava, and today we're investigating implied volatility, which is one of the most important concepts in option valuation, as it highlights one of the most fundamental sources of option value, which is volatility of the underlying, and second, it presents the informational value of option markets, because we can use option prices to form market implied predictions of the volatility of the underlying itself. And today we'll investigate the example of Tesla, and it is currently, as of the 24th of April 2023, trading at $162.83 per share. We have also got some data on option prices based on the strikes that are quite close to the price of the underlying, so strikes that are close to being at the money. And we have got data on most recent premium on both call and put options. Those call and put options are all for 19th of May expiry, so around a month until expiry, and we'll use those option prices to try to figure out what does the market believe is going to be the level of volatility of Tesla returns in the nearest month. For that, we need to first choose the option that will base our implied volatility calculations on, and let's say we are starting at 160 strike. Let's input 160, and we'll compare the implied volatility that's given by the call option and the put option and discuss some potential ramifications of that. But first of all, the conceptual procedure behind calculating the implied volatility. We all know that the Black-Scholes model can be used to extract the fair value of either a call or a put option based on the current price of the underlying, the strike price, the risk-free rate, the maturity of the option, and the volatility of the underlying. Most of the time, everything except the volatility of the underlying are directly observable. Therefore, we can plug all of the parameters that are known, apart from the volatility of the underlying, assume that the Black-Scholes model correctly prices the option, and figure out the only unknown variable, which is the volatility. Basically, implied volatility is the level of the volatility of the underlying that makes Black-Scholes valuations fair. So first of all, we need to figure out the maturity in years. For that, we can subtract the current date from the expiry date and divide by 265. So here we've got the maturity of around 0.07 years, slightly less than a month. The level of volatility we just guess and then allow it to converge to the value that makes Black-Scholes valuation fair. So let's say 30%, we start with 30%. Risk-free rate can be retrieved directly from, let's say, government bond yields. So let's assume it to be around 4%. Then we can calculate D1 and D2, as in usual Black-Scholes, using all of the data that we know and the guess of our volatility level. So for D1, we need to figure out the natural logarithm of the current spot price for the underlying, subtract the discounted strike price, so strike price times the exponent of minus the risk-free rate times maturity in years. That's the numerator. In the denominator, we'll have the volatility times the square root of maturity. For D1, we add half of volatility times square root of maturity. And for D2, we need to subtract it. So we can either copy this formula and change this plus sign into a minus sign, or we could simply subtract volatility times the square root of maturity from D1, which will give us D2. And then we can plug in the fair value formulas for both call and put. So for the call, we multiply the current spot price by the standard normal distribution, cumulative of D1, 1 for cumulative, and subtract the discounted strike price, so strike price times the exponent of negative risk-free rate times maturity, and that we multiply by the standard normal distribution of D2, comma 1 for cumulative. We see that the fair value of the call, if we assume volatility to be 30%, is 6.85, whereas in the real world it's 11.9. So if we believe that all other assumptions of Black-Scholes are correct and all other inputs are indeed correct, then the only way how this can deviate from the real-world market price is that our volatility assumption underestimated, quite drastically so, the level of implied volatility of the Tesla stock. So Tesla implied volatility would be much higher than 30% for this price to be justified. However, we can also perform the same calculation based on puts. For that, we need just to change the plus signs to minus signs in the fair value of the call formula. That would be quite a bit quicker. So we change this plus into a minus, this plus into a minus, this minus into a plus, and this plus into a minus to reflect the put-call parity condition. And that produces a very similar picture. The fair value of the put is much lower than the market price for the put at 160 strike if we assume a volatility level of 30%, again, meaning that the implied volatility level is much higher than 30%. But how much higher? For that, we could either use a numerical optimization algorithm like Solver that's built into Excel, or just as in the good old days, use the Newton-Raphson iterative procedure. I'll show you both ways. So let's start with the Solver algorithm first. In Solver, we need to specify our task. Let's say we are calculating the implied volatility based on the call option at the strike price of 160. So we want our fair value of the call, that is just calculated in cell B12, to be equal to 11.9, which is exactly the market price that we observe. And we can only change the volatility that we have guessed initially. And the only thing that's left to do is to press solve. And then we see that, first of all, the fair value of the call converges directly to 11.9, which is the market price, and volatility goes up to 60.57%, which is a spectacularly high level of volatility, Tesla being a notoriously volatile stock. If we would like to do it based on the put option, we can click solve once again, change our objective cell, which will be now the fair value of the put, and input the value of the market price of the put, which is 6.25. We press solve, and based on the fair value of the put option, implied volatility is quite a bit low at 46%, still dramatically higher than 30% we initially assumed. We can see a massive deviation, 60%, 46%, or depending on whether we select the call option or the put option. That might signal that either bid-ask spreads are quite large on this market, or that Black-Scholes model does not really work for Tesla, and there are other considerations apart from volatility that can impact the pricing of those options. Primarily, let's say, heavy tail considerations that would lead investors to price in not only volatility but higher moments of the return distribution. But continuing to assume Black-Scholes works, we can now change the strike to 165 and reevaluate our implied volatility for those two options. Let's say we click solve. Now we want to vary the fair value of the 165 call, and we want it to be equal to 9.1, which is the market price. This gives us a value of 58%, very close to 60% we had from the 160 call. And finally, if we want to evaluate it based on a 165 strike put, we can allow cell B13 to converge to the value of 8.39, which is the market price of 165 put. Click solve and get a volatility figure of 44%. So we see that the range of implied volatility estimations for Tesla is quite wide. However, what about the old school Newton-Raphson algorithm? Let's say that we want to estimate our implied volatility based on 165 strike put, and we start with the same initial guess, volatility of 30%. What we need to do then is to see how much does the fair value of the put or call, depending on what you use, deviate from the market price. Then we need to figure out how sensitive the fair value of the option is to changes in volatility, and use the Newton-Raphson procedure to converge to the true level of implied volatility using a set of iterations. So we need to calculate D1 and D2, we need to calculate fair value, and we need to calculate the sensitivity of the fair value of the option to volatility. And this, in the option trading tradition, is denoted as vega, which is a pseudo-Greek letter. There is no such Greek letter as vega, but it denotes quite famously the sensitivity of fair values of options to volatility. Quite handily, it is the same for both calls and puts. Both call options and put options are sensitive to change in volatility in a very similar way, so we can use the same formula for vega regardless of whether you're using a call or a put. And this formula uses the spot price, P. It uses the probability density function of the standard normal distribution applied to D1, and it uses maturity to figure out the sensitivity of the option price to volatility. We'll use it in our Newton-Raphson procedure. First of all, we need D1 and D2, however. This is nothing new. Natural logarithm of the underlying price locked minus the natural logarithm of discounted strike price locked, times the exponent of negative risk-free rate locked, times maturity locked. That wraps up the numerator. In the denominator, we input our assumed level of volatility times the square root of maturity locked. And for D1, we add half of the assumed level of volatility, which is over here. We do not lock it as we want it to converge with iterations, and multiply by the square root of maturity locked. That gives us D1. For D2, we just subtract our assumed level of volatility times the square root of maturity locked. For fair value, again, we are basing it on the put, so we need to translate this formula into the language of Excel. So minus the spot price locked times the standard normal distribution of negative D1, 1 for cumulative, plus the appropriately discounted strike price, so strike price locked times the exponent of negative risk-free rate locked times maturity locked, and times the normal standard distribution of negative D2, 1 for cumulative. We see that at 30%, the fair value of the 165 strike put is quite below 8.39. We need to figure out how sensitive this fair value is to a change in implied volatility, and figure out by how much do we need to increase this volatility in the next iteration. For that, we need the vega calculation, and that is quite easy to do. Spot price locked times the standard normal distribution of D1, and here we need to input 0 for probability density, so not cumulative, and times by the square root of maturity locked. We see that vega is equal to 16.93, which basically is an indicator of by how much does the fair value or the price of the option, in this case put option at 165 strike, increase or decrease subject to increases or decreases in volatility. So if volatility increases by 1 percentage point, we can assume here that the fair value of the option would increase by around $0.17. And we can check that. If we increase our volatility by 1 percentage point, we can see that the fair value jumps from 6.03 to 6.2. So this particular estimation is quite useful for this sort of analysis. But we want to figure out at which level of volatility the fair value of the option matches the market price exactly. And for that, we need to perform the iteration. We need to add to our volatility the difference between our fair value, which we log, minus the estimated fair value divided by estimated vega. And that gives us a volatility of 43.94% in the first iteration. In this formula, we can see that if our fair value is below the option price, we increase our implied volatility, and if it's above, we reduce our implied volatility. Quite consistent with the logic of option pricing, and also given the fact that vega is positive. And now we just need to enforce the same calculations again. And here we see that even in the first iteration, our fair value is strikingly close to the market price at 8.39, which means that 43.94% implied volatility is close enough to the true value of implied volatility. We can actually see it over here. We estimated using solver is 43.91. But what happens if we do another iteration? In this case, we converge to 8.39 almost exactly, and we converge to the true value of 43.91%, which we estimated previously using solver, using just 2 iterations via the Newton-Raphson method. And this is the method that used to be quite dominant when numerical optimization tools were not readily available and option traders had to do with what they had. This is how you estimate implied volatility of the underlying directly using option markets, using a Black-Scholes model and either solver or Newton-Raphson. However, there are simplified and much more straightforward approaches that estimate implied volatility that we'll address in our future videos. Please leave a like on this video if you found it helpful. In the comments below, I'm eager to see any further suggestions for videos in business, finance, or economics you would like me to record. And please don't forget to subscribe to our channel and consider supporting us on Patreon. Thank you very much, and stay tuned.